Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is real estate investment expert Saket Jain. Now, Saket is the founder and CEO of Impact Wealth Builders, as well as a best-selling author, tech enthusiast, and philanthropist. Now, his real estate experience spans more than 15 years, but over the last 5 years has focused exclusively on B and C multifamily apartments in markets that have strong underlying fundamentals. Now, in addition to investing, Saket currently serves as a business operations leader at Airbnb Headquarters. And so, guys, I'm excited to get on with Saket here, but just a few things before we go into it. Just a reminder for those that haven't done so already. Be sure to go over and grab your free copy of my best-selling book, The Cash Flow Investor, How to Create Financial Freedom Investing in Commercial Real Estate. You can go over and grab your free copy at kevinbupp.com/free book. Again, kevinbupp.com/free book. And with that, guys, I'd like to welcome our guest for today's show, Saket Jain. Saket, how you doing, my friend?
I'm good. Thank you, Kevin, for having me on the show. Appreciate it.
Excited to have you here. Excited to learn everything and anything about what it is you do in real estate. And so maybe I did that brief introduction. I know there's a lot more to it than that, and so I'm going to pass it back to you for a few moments and let you tell our listeners, fill in the blanks, and tell them a little bit more about yourself, what it is you do, and yeah, we'll go from there.
Yeah, definitely. Let's start with a little bit of backstory. If my accent didn't give away or my name didn't give away, I grew up in India. Moved to this country about 22 years ago now. And if anyone of your audience knows much about Indian culture, real estate is pretty entrenched in that culture. So as soon as I came to this country, I started buying real estate in the first few years. Once I got my bearings around how the world works here, how the culture works, how the financial system works here, I bought my first condo. And since then, we've been buying properties. But as I say that to a lot of my friends and family and my own investors, saying, I did not start the journey of an intelligent investor. Not that I'm calling myself intelligent, but definitely aspire to be one. In 2016, when I got laid off, that's really when it hit that I had been buying real estate for appreciation, not necessarily for cash flow, right? Which is fine. It serves a purpose, but it didn't serve a purpose of me diversifying my own portfolio because everything was concentrated with one single income source, which is my job. And I didn't realize how fragile that was. I mean, I knew it at the back of my mind, but it was never at the forefront. That's when I started shifting my portfolio into more cash flow positive, yet appreciating assets. And the more I researched on it, real estate trumped. So we started exchanging our single family portfolios to the appreciation centric single family portfolio to cash flow centric, because my appreciation centric portfolio were cash flow negative as well, right? So not only I didn't have cash flow, I was actually putting more money into it. So once I started doing that, I really realized that it's going to take me 1,000 years to scale to where I need to scale to. So what's the next best way of scaling my own portfolio? And being an operations person, I'm like, you know what? The only way to scale is instead of buying more, I need to buy more quickly, right? Before it was, let's just acquire more and more. Now it's more like, in the short amount of time spent, what more can we do? How can I acquire more and more portfolio? And multifamily sort of trumped it for me, not just the cash flow positive nature of it, but also the tax efficiency nature of that through depreciation. And along the way, I found a job at Airbnb. And that actually became an icing on the cake because I knew the company was going to go public at some point, and I'm going to get taxed crazy. So I'm like, this. I've now built up a muscle and a portfolio to make my life more tax efficient. And then it became like, why am I not offering it to anyone else? Let me just bring it to others who are actually in similar position like me. Now, hopefully, you don't have to get laid off to learn that lesson, and hopefully, you're proactive in building your wealth and building your portfolio in a more tax efficient manner.
Yeah, no, I appreciate that. Appreciate you sharing kind of a background there. And talk to me about the real estate you once owned to the real estate you own today. We know that you're in BC class multifamily apartments. Prior to that, you owned some like single family residential properties that were cash flow negative. What markets were you buying in back then? And then ultimately, where are you spending your time and efforts today?
So at that point, I was not doing, I think for me, it was more about, hey, I just want to own something. There was no intentionality behind it of
Mhm.
what I wanted to own. There was no investment thesis that I had developed. So a lot of my single family portfolio was in and around the places where I was, right? If I was living somewhere for more than 6 months, and I was a consultant, so I was traveling crazy. If I was going to live somewhere for more than 6 months, I'll just buy a property there, right?
Got it.
I had no analysis of, is it the right market? Is it business friendly? I mean, of course, now I have more sophisticated way of buying properties. It was more about what's convenient, and can I go check my properties myself, and can I manage it myself, right?
Mhm.
To now post 2016, let's figure out the markets. And within the single family portfolio, I was spread across, still buying in appreciating markets somewhat, but also looking at hybrid markets, right? Kind of looking at cash
Mhm.
flow neutral, which is more cash flow appreciation neutral, I should say, which is 2 to 3% raises, right? Kind of like the linear markets, the hybrid markets, and the appreciating markets. I started diversifying within those markets itself and relying more on third party management, which so I had to become comfortable with the fact that I don't want to manage my own properties. That was the
Mhm.
biggest shift, I think, from what I owned before to what I shifted in 2016 timeframe. And now we don't manage anything ourselves. And I would say 90% of my portfolio is in multifamily.
Got it. Got it. No, appreciate that. And talk to me about I guess the pivot time frame, but
Mhm.
more specifically, maybe let's take a focus on that very first transitional deal. So
Mhm.
that first multifamily property, what was it? The size of it? What was attractive, about that deal to you? And just again, I always like to lay the foundation. I
Yeah,
feel like that is the foundation of the second phase of your investment journey.
correct, correct. I think, for me, like probably most of the passive investors, um, and somebody who's very good with numbers, the problem is analysis paralysis. So I found my first deal, our first operator that I was going to work with. It took me about 3 weeks of pretty much 3 to 4 hours every day to understand what's happening in the deal, to dig through the numbers. By the time I was ready to invest, the deal was gone. You know how these things go. They get most of the good deals get oversubscribed in a very short amount of time.
Mm-hmm.
And I had no idea, especially back in 2016, 2017 timeframe. Now the market's changed a little bit. So you may have a little bit more time. But back then, deals were getting subscribed in like 24 to 48 hours, not necessarily taking weeks, some of the deals at least.
Mm-hmm.
So my first deal was a big blow on my own face that what am I doing wrong? What am I doing different? And how can I make the decision faster? So I started having my own decision criterias of I was trying to analyze a few things at the same time. I was trying to understand how to work the multifamily space. That was my first foray into it. Back then. I didn't have any mentor or a coach. I was just trying to learn by myself through reading and through analysis. What has happened was I'm like, you know what? I need to develop a criteria, and if the deal doesn't fit that criteria, I need to move on. That's the first thing.
Mm-hmm.
The second was if the operate actually not in the same order. First one was if the market and the operator does not fit my criteria, I'm out. I don't even look at the deals, right? And even within the deal, what I realized is it's never the deal, because a deal is a bunch of assumption packed into an Excel spreadsheet with a beautiful number spit out, right? That's exactly what a deal is, because the business plan is yours and mine, Kevin. I know you're good. You're heavy into this space as well. It's all our best foot forward in what can happen in the future. It's never a projection that anyone should rely only on. It's the competence, it's the capability of the operators. That's really their business acumen that's going to make that deal a successful, right? What I realized very quickly is a good operator can turn a bad deal into a great deal. On the flip side of that is a bad operator can turn a gold into a coal very quickly, right? So I'm like, you know what? I need to figure out where to put more weightage on. So I shifted away from putting 20, 30 hours of due diligence into analyzing a deal versus putting a lot more emphasis on who am I going in with, who are the partners, who are the operators, what their roles, what's their track record. I got a lot more clarity up front. And when the deal happened, when the deal came through, I had already made up my mind of whether I'm going to go into this deal or not. Now I'm not trying to find why I should do the deal. Now the question I was asking is, why should I not do the deal?
Mm-hmm.
Right. And that question just helps you reframe. Seems like a very simple switch, but it actually helps you find core issues rather than dealing with every single line item on an Excel spreadsheet.
Yeah. No, I agree. I'd love to chat with you about your criteria as it relates to sponsors. Finding that right jockey to place your
Hmm.
bet on, right? And so, give me an idea of what that looks like for you.
Yeah, for me, it's really on about, first of all, my mission and my values. Do they align with them? I forget about the business sense of it because I look at investing as a 5 year marriage, at least 5 year marriage, if not more, right? Because especially nowadays, if you're investing in a transaction with somebody else, it may be a 3 to 5 year hold anyways, because given the more volatility of the market.
Hmm.
So can I actually deal with that person for the next 5 years? And a lot of that is not about being friendships, but if I'm asking questions, if I'm asking transactional related questions, how easy it is to get that answer and
Hmm.
how non-jargon is that answer given to me in, right? Because what I don't want is I don't want a Wall Street jargon which confuses the hell out of me. I have been there of how stupid you feel as an investor when your financial advisor is just throwing out supply demand curves at you, right? So I'm like, okay, this person is not necessarily here for educating me. They're just trying to look smart in front of me, right? So part of that is that how are my values aligned? What's the communication style? Once I can cross that, it's really about what's their track record, right? And are they the operator or are they capital raiser? What role they're playing? Who is the main day-to-day asset manager on that deal? Before, I used to look at, am I, so let's just say, Kevin, if you're the capital raiser and somebody else was an operator, first, before I would say that, hey, I trust Kevin. Kevin is doing his due diligence, and Kevin's going to work with an operator, so maybe I can have that trust association, right? No. For me, it's very different now. Now it's more about, yes, Kevin is great and I trust him, but I want to also know who the operator is,
Hmm.
right? Who the asset manager is, because they are the guys and gals who's going to make this successful or not, right? Now, the third criteria from there is going to be, once I know that, the questions I'm asking from them is, have they done this type of an asset before, right? Because I may be an excellent operator for mobile homes, but if I now switch to multifamily, while the skills are very transferable, it's a different asset class, right?
Hmm.
So what enables me to make sure that I know what I'm doing? Now I may have a partner like you in the deal who can bring that advisory or bring that hands-on experience, and I can benefit. Me and my investors can benefit from that. But that's what I want to understand. What is their experience in managing this specific asset class? And also, have they done this before in terms of have they gone full cycle ever before, right? Or are they going to learn, last 5, 6 years? Chances are, even if you made any mistake, the timing in the market's going to fix it for you, right?
Well,
So,
let's hit on that point. That's an
yeah.
important. And I was going to point it out, and you beat me to it. So let's talk about that because the rising tide lifts all boats, right? And
Mhm.
definitely the past 5 to 6 years, even if you were a poor operator, more than likely the cycle of the market
Mhm.
carried you out of it, right? It lifted you
Yeah.
out and covered up your mistakes. And so how do you for getting involved with a sponsor that maybe has only been doing this for 5 or 6 years and they've got a
Mhm.
phenomenal track record over that period of time.
Mhm.
They've had some great full cycle deals, just phenomenal IRRs above projections, which has kind of been the
Yeah.
norm for the past 5 years, right?
Yeah.
It doesn't necessarily set them apart above all the rest. And so how do you separate the great from the mediocre meaning like
Yeah.
things were great for the 5 years but like ultimately that might not be the case for the coming couple of years ahead of us.
Yeah, I think it's really for me, and it's not, unfortunately, it's not a black and white answer, right?
Yeah.
Excuse me. It's not a black or white answer because just because somebody doesn't have an experience of 5, 6, 10 years does not mean that they can't do
Hmm.
their job, right? So
Yep.
I'm going to paint a generic picture, and there's going to be tons of exceptions, right? So really, I think what I look for is what were they doing 5 years ago? So let's just say they started 5 years ago, right? What was their experience 5 years ago? What were they dealing with? So I'll talk about my specific experience. I was working as a management consultant. We were trying to buy businesses with private equity, turn them around, and sell it, right? So if you now look at the skills transfer, and if I were the operator, let's just say you or your audience was looking at me as an operator, even though I may have started 5 years ago, what I was doing before that 5 years completely translated to what I'm doing now. Because
Mhm.
what are we doing now? We're buying businesses, which is apartments in this case. We're turning them around, which essentially was making them better. And then once we see the NOI increase, the value increase, we sell it. That's the exact same stuff that I was doing in the past. So while there may not be a one-to-one correlation for the uninitiated, but if you actually dig deeper into my own experience and what I've done in the past, you'll be able to figure out this is not this is not one-to-one. I may not be somebody who's been doing real estate or multifamily for 30 odd years, and I've seen multiples ups and downs. But this guy and gal or gal has seen a market swing, a business cycle swing in a very different industry. So they have lived through those ups and downs, and they are savvy in a business. They have a business savvy, right? And I think you would agree, hopefully, with me, is that multifamily is not you're not buying a real estate, you're buying a business.
Mhm.
And if you don't have the operator who has an understanding of how to run a business and how to look at the financials in a way that's going to be more effective, they don't know how to budget, they don't know how to hire people and incentivize the teams, you're not going to be a successful operator for
Yep.
multifamily, right?
Yep. No, that's fantastic. I appreciate that, and would love to chat with you about kind of the, I guess the flavor of choice, which is BC quality
Mm-hmm,
assets, and there's been a little bit of a, I guess, an argument from both sides of the table over the last couple of years. BC quality assets really weren't trading that much higher of a cap rate
mm-hmm.
than that of newer built, newer vintage Class A
Correct.
assets. And so a lot of operators, we saw kind of a shift go from doing the value add BC stuff to do a very light value add, but mostly just buying into a stable A class
Mm-hmm.
asset. What are your thoughts there? And ultimately, is your focus still the same today in the BC class market?
So yes and no. So we still look at BNC because that's been a bread and butter for us. But and I think this show is going to be released once my new deal is going to be closed. But it's a 506C. We can definitely talk about that. Which is we're also looking at where is the most amount of leverage that we have in terms of our time, our money, and our and market macro situations itself.
Mm-hmm.
Where can we deploy our capital, which is going to be the most efficient return on that, right? And Class A is shining right now for us. So we have this is the first asset that we have acquired now, which is going to be a Class A asset in Myrtle Beach, 252 unit, 2022 built, right? So it's completely new. But what we're doing in this deal is, which we couldn't do in BNC, is we're getting a stabilized asset, which almost 80% occupancy before we occupy it. And we're already working with the team, with the existing team on the ground to bring the occupancy closer to 90% before we acquire, right? So now at that point, at the rental increases that we were thinking we're going to make. So a lot of the leases were going to be priced at what the new pricing that we were thinking about adding to our once we acquire, right? We were able to get a 50% LTV, 50 to 60% LTV. We're getting a fixed price loan for 5 to 7 years. We're basically projecting now out to hold for 5 years, maybe 7 years, instead of saying 3 to 5 years, right?
Mm-hmm.
We're shifting the mechanics in a way that we're now have to train our investors to think differently. Gone are the days, at least in the short term, where we can talk about 10 to 11% cash on cash, right? We have to figure out if you can get 6 to 8% cash on cash right now, that's not a bad number as long as it's rooted in some risk aversion, right? Because our conservative risk management, because that's been most important. The problem with the value add becomes right now is if you buy it incorrectly, we don't know where the supply dynamics is going to be in the future, right? Is it going to be constrained? Is it going to be relaxed? Where the inflation is going. So anything that we plan on to build, unless we vertically own everything, and we have our own warehouse, we have our own construction company that we can control a lot of those costs, which very few operators do. But if we could, then we can say that we already pre-purchased all the material. We have already W2 employees to do the construction management, so we can now reduce the risk, which is exactly what we did in the last deal that we had in Phoenix, right? That's exactly how we did it with a vertical integrated operator that we could control some of those nuances. But the more we do it, we may not be able to do in every single market we want to move into. That's where we pick the Class A asset, but that does not mean we're giving up on B or C. It's just that we're trying to do what makes sense in the market that we're in.
No, that makes a ton of sense. And just to clarify, is this a new build you guys are purchasing from the developer or?
We're purchasing from a developer. Yeah.
Okay.
So it's a
Fantastic.
developer who has gotten to a 70-80% occupancy. And we're basically, the goal is going to be in this case, now, the developers are not the best multifamily operators. So sometimes they're the best ones to buy from, because there's a lot of meat left on the bone. They have not necessarily optimized all the other income sources. So we can make sure we can optimize to that. And also the expenses are not up to the par. They don't have the best property management companies that we could deploy. So that we're now buying a business that was developed by an entrepreneur, started by an entrepreneur who didn't necessarily know how to best run it. Then that's not a ding on the developer. That's not the business they're in.
Mhm.
They're not in the business to run the multifamily. They're in the business to develop a multifamily, most developers. So we're buying it from them and then bringing our own expertise and making sure that we can extract the most value out of the deal we can.
Given the volatility in the capital markets, one of the questions I'd love to get clarity on is what type of debt you mentioned. I think 7-year fixed term debt.
That's what we're looking for. Yep.
Is it Freddie Mac or who's going to
No,
come
it's a
in?
private lender. It's a
Okay.
private lender, private bank. It's not even a bank. It's a private lender
Really?
who we have a good
Interesting.
relationship with.
Okay.
And we were able to now. I think it's all the basis of the operator that we're bringing in. It's
Mhm.
because through their portfolio, through what they hold, they're a $1.3 billion asset under management operator. So we could negotiate a lot more, and they've worked with this private bank in the future, in the past as well. So we're able to negotiate some better
Understood.
terms, fixed price, minimal yield maintenance. Kind of like we're basically trying to see what can we do to minimize the risks for our investors. And I actually give you a comparison. A friend of mine is rehabbing the entire historical district, or historical property, in sort of northern states, and he has a 3 years of construction plan, and their returns actually don't supersede ours. So when we start looking at the risk adjusted returns on a deal
Mhm.
which is high value add, the risk is so high.
Yeah.
Now you have to equate, when you look at the return ratio, it may not make sense to do a deal like that.
Yep. No, agree with you. And would love to chat with you about. I know that you're currently with Airbnb. Just really get some feedback from you as to juggling. You've been at real estate now, just buying a property wherever you lived originally, right? And that's a lot simpler than that of really learning the entire other side of the business, which is the
Correct.
multifamily game, and just having a firm handle on that. So, talk to me about doing that while also juggling a full-time job. How does one do that?
I think you learn to realize that you need a team, right? You need a team, you need
Mhm.
partners, you need somebody who is watching out for you in different areas, both at Airbnb and at both at your work in general sense, and also in this business, right? It's not a single. If you were the only person doing everything in a deal, regardless of what your role is, if that's the only thing you're doing and you're the only person doing it, there's not enough time in the world. And usually, what we know is it's your work, it's your life, it's your health, it's your family. Some aspect of your life is going to suffer the most. And I found that, Kevin, it's interesting you asked that question on my first deal. Me being me, I'm like, I'm going to find my first deal myself, because I couldn't figure out who to partner with on my first deal. It was a off the market deal with my relationship with a property management company. And of course, I had to do it the most crazy way. I bought a 262 unit portfolio deal with 3 different apartment buildings. And I mean, look, to my own credit, and I'm patting myself on the back, we got it all right. I figured out the underwriting model. Everything made sense, and still a great deal. However, it took the 5 month out of my life. I did not see my kids. I did not see my wife because I was working full time. I was basically deployed in Alabama. I was sitting there so that I could finish up my work in the morning and then go look at this deal and look at all the due diligence and everything else. Because I was the only one doing it. Now I brought partners later on, but it took a lot out of me. So after
Mhm.
that deal, I really thought about, like, what do I want to do? Do I want to live like that? Because what's going to happen is eventually I'm going to get burnt out, or eventually I'll have no family, or eventually I'll have not my health. One of the aspects is going to get so off skewed that I won't have the time to repair it. So that's when I realized, I'm like, you know what? It's fine. I need to do all the things, but that does not mean I go at the intensity and the capacity that I went before. So I started partnering more with people. I started building my ecosystem where one phone call, I can do a lot of different things rather than me being on the road for 10 days.
Yep.
Right. So that just kind of shifted me on looking at this business. And I think that's one of the biggest challenge for anyone who's moving from passive to active, because talking to most of the operators, especially the coaches and the gurus, unfortunately, which is not intentional, but unfortunately, sometimes it comes across as easy.
Yeah.
I don't think anyone is saying it's easy. Everyone is saying is here are the steps. But to the uninitiated, say, oh, you know what, a 10-step process, it makes sense. I got it. Let me go jump in, which is exactly what I did. And that's a challenge.
Yeah, no, I agree with you there. And so outside of real estate, is there anywhere else where you're putting your own personal capital? I mean, in crypto, in the markets, I mean, any
Yeah,
other place that
so
you're putting
not
your
the
emphasis?
markets. I mean, I have Airbnb stocks, as I tell, that's
Okay.
probably the only ones that I have in the market. And so, but where I'm putting my money is in oil and gas, in crypto mining. I don't do crypto trading. If I can own the entire mine, that'd be helpful for me. That's really I look at it. I'm looking at energy efficiencies because energy is a price. Oil and gas is not getting any cheaper, at least in the next 3 to 5 years. I don't see the prices going drastically down, and I don't see the renewable energy coming up with a pace in the next 5 years that our dependency on oil and gas is going to disappear. Right. So I personally see as an investment philosophy that a lot's going to happen in the energy space. So we're trying to carve into that. We're trying to carve into other businesses as well. Like a friend of mine recently bought a laundromat franchise.
Interesting.
We're trying to see if maybe there's a way to do that. I'm hearing a lot about car washes right now, so we're trying to look at the
Yeah,
operators about car
it seems
washes
like there's a new car wash literally every quarter of a mile, at least where
every
I'm based
quarter,
out of.
right? Yeah, no, completely. So I think there's a space there's a trend. So I watch trends, right? Kind of like
Yeah,
as a
absolutely.
consultant, I'm always looking at what's happening in the world, because what I don't want to do is being the best advocate for my own investors and for my own capital. I want to make sure that I'm ahead of the curve and I'm ahead of the trends, if not one step behind the trend.
Yeah.
Right. That's where my goal is now. Can I always accomplish that? No. But if I have that goal, maybe I'll be 2 steps behind, not 50 steps.
Yeah, absolutely. And interesting. Speak about the car washes. I interviewed a guy about 6 years ago. I did a car wash series. This is before
Oh, you did?
but this
Wow.
is before. I love niche asset classes, and this was before they are how they are today. They weren't exploding, but the express model car wash was in
Hmm.
existence, and that's like the that is the that's like the newest theme, right? With the free
Right.
vacuum, drive through the tunnel.
Of course.
And I was interviewing the founder of Autobell Car Washes, which at one point was the largest privately owned car wash company in the country for many years. I mean, it's like a 50-year-old company,
Hmm.
50 or 60-year-old company, based out of, I believe, the Carolinas somewhere. But either way, was interviewing him, and at that point, my office was right down the road, literally probably 100 yards from. I can't remember the damn brand, but it was one of the express car washes. It had been there for a couple of years,
Uh-huh.
and my prior experience with the car wash, like the automated car washes, is they ain't clean. You drive through,
Yeah.
your car's wet. Once it dries, it's dirty again. Right?
Correct.
It really didn't do a
Correct.
good job cleaning. And he encouraged me to go down and actually drive through. And it happened to be pollen season, and so I drove my vehicle through. It was a mess because it's yellow everywhere, and it came out probably 95 to 97% as good as what it would have been done by hand, which was just blew me away.
Amazing.
Absolutely
Yeah.
blew me away. And so I think the technology has really advanced over the
It
last
has. It
decade in the car
has.
wash space to where you actually are happy with the results when you drive out the other side, and
Correct.
you feel like it was actually worth the $10 that you spent.
Yeah, I think just kind of like talking a little bit step further there, right? Because the multiples on a car wash um, could be like 20x,
I
right?
know.
So as an investor, when you start thinking about it, yes, I mean, what you said is great, right? The quality has to be acceptable, because if you were doing a 60% car wash, 60% quality, people are going to stop going eventually,
That's
right?
it. Yeah,
But if you're hitting
you're not going to sell
97,
the memberships, and the
98%, no, you're
memberships
not
is a
going to sell
big
the
part of that
membership.
revenue base. There
Correct.
is
And now
selling
they've
monthly memberships.
basically adopted the tech world of doing a subscription model.
Yep.
And subscription is like $5 a week. So as an investor, you're like, you know what? How many people are actually going to go for unlimited car washes? Not that many.
No.
Maybe the first week, maybe the second week, but eventually once a month, once a week is the max, right?
Yeah.
So that's I love the business model. I love the asset class. I have not necessarily I've invested with a few. I've not necessarily brought it to my investors yet, but that's a plan to bring asset classes like that, which augments multifamily. I don't think it's ever going to be replacing multifamily.
Sure.
It's always going to be an augmentation strategy.
I agree. Well, Saket, it's been a lot of fun having you here. I really appreciate you coming on. For those that want to learn more about you and what you've got going on, where's the best place to find you?
My website, impactwealthbuilders.com. And I also recently launched my own podcast, which, Kevin, I would love to have you on. It's called Migrate to Wealth, which essentially are the two major places where you can find me. Again, impactwealthbuilders.com, and the podcast name is Migrate to Wealth.
All righty, fantastic. Well, Saket, again, pleasure having you here, my friend.
Oh, thank you. Thank you again for having me. I really appreciated the conversation. Thank you.
All righty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin, wishing you huge success. Take care.